All right. Good morning, everyone. It is 8:45 on the morning of November 17th, 2022, and this is my pre-market strategy session. And so today, the title of the video, and I forgot to change the date, but I'll change it after I finish this video. It says November 15th right now, but it's the 17th. QQQ bear market rally pullback and a gap to fill. So what we have going on here is it looks like this low over here that was put in early September wound up being a point of resistance for this bear market rally that was taking place. We're in this channel, this downward facing channel. So it's in my opinion that now that we've tested the bottom of the channel quite a bit, that we're going to start testing the top of the channel for a bit, and that the Qs are on their way to do that. No, it's not going to go straight to it, obviously. There was a huge reaction here. I think this was after the recent inflation numbers came out. There was a huge move to the upside. Actually, let's look here real quick. From November close on November 9th, on November 15th, there's an 11% move. That is enough. If anybody's levered to the short side, that's enough to rip a lot of faces off. So now that a bunch of faces have been ripped off on the upside, or a bunch of faces have been ripped off who are short, a bunch of people who started to get long up here are about to get their faces ripped off too. Bear markets are notorious for ripping faces off to the upside and the downside. And so the idea is to get in front of these moves, of course. And so what I'm looking at now is here's a gap to fill, right? This gap between November 9th and November 10th. And it's an enormous gap. And in a technical sense, for the chart to be what's the term for a chart that's you can't really call it broken. There's just incomplete price action, and the idea from a technical sense is that price will come back to amend or to fix the chart, and the idea is to fill this gap and find support down here and then continue higher. So from this point, you can see from yesterday's close down to the open on the 9th of November is another 6% to the downside. So trading to the downside right now looks attractive to me because it's in the direction of the trend. The trend is your friend. And so taking trades to the downside is definitely on the table. Let's take a look real quick. It's probably going to be oversold, or it's oversold in the pre-market. Now, crashes can happen from oversold conditions. So here's the 1 minute, and it's out of oversold conditions, but it's heading back in there. And then the 10 minute is definitely buried in oversold territory. So it's looking really bearish today, and it's probably a really good day to sell the rips. So if there are any up moves today, like at the open, or an hour after the open, if the market is up from the open, it's probably a pretty good day to sell the rip, sell into this move. Ultimately speaking, a gap this morning, a gap down this morning, would, ideally, it would rip back up to its previous close, which is at a whole bunch of numbers, roughly 285.44. I'm getting alerts on my computer, it's really annoying. 285.44, and then find meet resistance right there, and then start just moving its way down to the gap, here's the top of the gap, and then eventually down here to the bottom of the gap. Find support here at the bottom, somewhere around here in the bottom of the gap, and then move up to the top end of the channel. So I think that we are still in a bear market rally, and I think that this is going to be a nasty pullback in a bear market rally in order for it to come back and test the top end of the channel for the next leg down. Vicious moves, and so it's not time to really be in, the fast trades are really the best way to go. I'm talking like 10 minutes to an hour, maybe even 2 hours long, and just take profits as you get them. And the relative strength lines ought to give you a pretty good idea intraday of where to enter and exit for your trades. So you can see here the VIX is also going into overbought. And so a move out of overbought on the VIX toward oversold, and out of oversold on the Qs toward overbought is going to be a strong move today if you want to trade to the upside. I'm not going to trade to the upside today. I'm looking for the oversold conditions to wear out and go into overbought on the Qs, and for the VIX to come down and out of the oversold, out of the overbought and into the oversold for, wait a second, for a short move. I might get that opportunity today, I might not. I've been doing this for years and I still get confused. So that's pretty much the deal with the Qs today. Now, there's a crypto blow up happening. I'm sure anybody who pays attention to this channel is well aware. Let's see what's Bitcoin. Bitcoin is consolidating for the next big move down, and that ought to weigh on tech actually. And it looks like it's about to break. I mean, it really does look like it's about to start breaking down pretty quickly here. This is getting into really tight consolidation here. And another large move is looking quite imminent. This is a textbook bear flag, and the way that it exits this pattern tends to be the way that it enters. So there's a big move down, some consolidation, and the next leg down is on its way at some point in the I think is a rather near future. In any case, let's see, this is the neckline to a head and shoulders pattern, and price will continue to follow this trend for the foreseeable future, which is anywhere between 6 and 12 months. Next up, I saw an article. The title of the article was "Is the yield curve signaling trouble ahead?" And it's like, duh. I mean, the media is they need clicks, there is definitely an inverted yield curve, which is the precursor to calamity. I mean, essentially. So back here, this is 2001, this is 2007, leading into the 2007 crash and leading into the 2001 crash. And the crash doesn't happen. So while the yield curve is inverted, the market can top and start on its way down. In fact, in the 2000 and 2007 example here, the market did start to roll over at the tail end of the yield curve inversion. It did start to roll over here, but we didn't see the actual real big crash in 2001 until after the yield curve normalized. Same thing here with 2007, the Great Financial Crisis, the GFC. It started the top of the markets did come in within the first 3 months after the yield curve starting to get back to zero, but it's not until the yield curve normalized here, starting in June of 2007, that the big crash actually happened. So we are well on our way at this point to having already experienced bear market conditions, especially on the Qs. I mean, I think we're down somewhere over 30% right now from its peak. Yeah, let me kind of clean all this stuff up real quick, and we'll take a percent measurement. So it's really quite foreboding. So let's go from the close at the peak to where we closed yesterday. Yeah, almost 30% down already. So by the time this yield curve starts to normalize again, we'll have already been down, a significant amount. I mean, there is a big nasty crash coming our way even after a big move down. It's just that the crash usually doesn't happen. It just doesn't happen until the yield curve starts to normalize again. So the storm clouds. If forecasting, is you can forecast the weather. Given a whole bunch of conditions and temperatures and barometric pressure gradients and so on and so on. The forecast for the economy and for the markets, there's a hurricane, Category 5 hurricane offshore headed our way. It's gonna get crazy. It's gonna get real crazy. So for the time being, though, the market really can go sideways, up, so on and so on, even while an obvious forecast of a huge move down is definitely coming. It's just that it doesn't come to fruition until after the yield curve really starts to normalize again. So I think that after probably 2 or 3 more days, we'll see this kind of crashing down back to the gap again. Right there, the 267.76 roughly is where I'm looking for support for the move to the upside of the channel. Over the next couple of days, it's bearish, and I will be definitely looking for bearish entries. And right now, 285.44 is roughly the spot today. Today is roughly the spot where I will be looking to start some short positions for the move down to test this 267 level. All right, everybody. Let's see. We looked at Bitcoin, which is definitely taking a beat down. Yeah. So a little bit of a pullback here in gold. No surprise. It's had a pretty big run up. I don't know what the risk ranges are right now. I haven't looked at them recently, but I imagine that after this kind of move right here, yeah, you know what though? So this looks to me like a Wyckoff distribution, and that this run up right here is just kind of a sucker's rally. There's more downside to gold coming, and that this recent move in the past few days is just pulling a lot of people to the long side, just to be able to squeeze, to shake out some liquidity, which it's going to do. What else? Let's see. 10-year, 2-year spreads, the VIX. Yeah, here's another new higher low in the VIX. The next crash really could be, the next big leg down really could be pretty soon here. The VIX has got to break down again. But you're not really supposed to chart the VIX, but it's hard not to chart something like this. When I look at it, it's like as textbook as it gets. A succession of higher lows. and it looks to me like it's consolidating for a big move up. Yikes. Fingers crossed, it doesn't happen yet. So we'll see. But yeah, trading to the downside is definitely the direction of the trend. Hey, sorry I didn't post yesterday. I had my power went out yesterday morning at about 3 o'clock in the morning, and the power company didn't get it back up and going again until about 10:30 in the morning. A little bit frustrating, but no big deal. Yeah, probably wouldn't have traded yesterday anyway. Maybe, I don't know. Although yesterday would have been a rather textbook. I mean, look what it. So yesterday it opened up, gapping lower. In fact, today actually it may just gap lower, continue going lower. There may not be any gap fill. Yesterday was rather textbook. If you look here, so we opened at, I'll call it 287 roughly. Came back, filled the gap, and then took off to the downside for pretty much the rest of the day. That was textbook topping behavior. On a short-term basis on this move. So the possibility, that it comes back and fills the gap today, it's there. It's possible it could happen. We'll see. We'll see. It could gap down and just take off to the downside too. So just got to play it by ear. And yeah, actually watch volume and watch the level 2. If price is moving fast, and I mean really fast, then there could be a momentum trade here to the downside, which could be a really big red day, something similar to what we saw on the 2nd of November. So, okay. All right, everybody. Good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell, and I'll see you at tomorrow morning's strategy session. God willing that my electric company can keep the power on. All right. Take care, everybody. I am out.